You are sitting at a table. Maybe it is a casual dinner. Maybe it is a wedding. Maybe it is one of those uncomfortable high school reunions where everyone pretends not to compare themselves, but absolutely does. And then it happens. Your not-so-smart friend casually mentions they just bought another rental property, or that their small business had its best year yet, or that they are thinking about stepping back from work because they are financially comfortable. This is the same person who used to copy your homework, the same person who barely passed math, the one teachers quietly worried about. Meanwhile, you are the dependable one, the honors student, the scholarship winner, the responsible decision maker, and yet on Sunday night you are still opening your banking app with a quiet tension in your chest, still calculating margins, still wondering how you can be this competent, and still feel slightly behind. If that feels uncomfortably familiar, good, because today we are going to talk about something people rarely say out loud: why your not-so-smart friend makes more money than you do. Not because intelligence is useless, not because the system is random, but because money does not reward intelligence the way school did. In classrooms, thinking harder produced immediate results. In the real world, wealth rewards behavior under uncertainty, action over perfection, momentum over prestige. If you have a friend like this, or maybe you are that friend, feel free to share your experience in the comments. These patterns are more common than people admit, and if you want more conversations that challenge how you think about money and identity, consider subscribing. Now let's talk about the intelligence ceiling nobody warns you about. For most of your life, intelligence was the safest investment you could make. Study harder, think deeper, answer faster. You were rewarded for processing information efficiently. Every correct answer reinforced the same quiet belief: if I think better than everyone else, I will do better than everyone else. And for a while, that belief worked. Higher grades led to better schools. Better schools led to respectable opportunities. Early in your career, being sharp absolutely helped. You learned quickly, you avoided obvious mistakes, you impressed people in meetings. But here's where the model begins to crack. Income does not scale like test scores. At lower levels, intelligence clearly helps. Basic financial literacy, problem-solving ability, and competence matter. If you cannot manage cash flow or understand simple risk, wealth becomes difficult. But once you pass that baseline, something shifts. After a certain threshold of competence, raw intelligence stops being the primary driver of income growth. Other traits take over: tolerance for uncertainty, speed of execution, emotional regulation, reputation built through action rather than theory. This is the intelligence ceiling. It is the point where thinking better stops producing proportional financial returns. You can see it in real life. The brilliant analyst who can dissect markets, but hesitates to invest because the timing is not perfect. The engineer who understands compound interest in exquisite detail but waits for the ideal entry point that never arrives. The consultant who can design a flawless business plan but never launches because the branding is not refined. They are smart enough to see the opportunity. They are too smart to tolerate imperfection. Meanwhile, someone with average academic ability buys a modest duplex. It is not optimized. It needs repairs. The numbers are not elegant, but it cash flows. They learn through friction. They adjust in real time. They build experience instead of theory. And over 10 years, that difference compounds. Here is the uncomfortable truth. Intelligence is excellent at identifying risk. It is not always excellent at managing fear. The smarter you are, the more scenarios you can simulate. The more you simulate, the more potential downside you see. And the more downside you see, the harder it becomes to move. Your mind becomes a high-powered forecasting machine. But wealth is not built by forecasting alone. It is built by participation. And participation requires a willingness to act before you feel perfectly certain. The intelligence ceiling is not about being too smart. It is about mistaking understanding for execution. You can understand markets deeply and still never own enough assets. You can understand business models thoroughly and still never build one. You can understand negotiation theory and still never ask for more. Intelligence opens doors. Behavior determines whether you walk through them. And if your not-so-smart friend is ahead, it may not be because they know more. It may be because they crossed the ceiling faster. They stopped trying to be the most informed person in the room and started trying to be the most active. Smart people have a habit. They simulate. Before they invest, they model scenarios. Before they start a business, they outline contingencies. Before they negotiate, they rehearse objections. On paper, this looks responsible, and in moderation, it is. But there is a quiet line between preparation and paralysis. Highly analytical people can imagine more variables than average. They see macroeconomic risk, industry disruption, regulatory shifts, competitive pressure, liquidity constraints, tax implications. They do not just see opportunity, they see fragility. And the brain has a bias. It weighs potential losses more heavily than equivalent gains. Behavioral economists call it loss aversion. Neurologically, potential downside triggers stronger emotional responses than upside triggers optimism. Now combine that with a mind capable of generating 20 plausible downside scenarios before breakfast. You do not just see risk, you feel it vividly. So you wait, you tell yourself you are being prudent, you read one more article, you watch one more breakdown, you refine one more spreadsheet. And while you are optimizing your entry, time is compounding for someone else. This shows up constantly in investing. The intelligent investor who wants the perfect allocation. They debate 70-30 versus 60-40. Domestic versus international weighting, factor tilts, tax efficiency strategies. Meanwhile, their less analytical friend opens a brokerage account, buys a low-cost index fund, sets up automatic contributions, and goes back to work. Is their portfolio optimized to the decimal point? No. Is it invested? Yes. And invested capital learns faster than theoretical capital. The same pattern appears in business. You might spend 6 months building a brand identity, refining messaging, mapping out projections. Your friend buys basic equipment, underprices at first, gets clients, makes mistakes, adjusts. They learn in public, you learn in private. The problem is that markets reward feedback loops, not thought loops. When you act, reality responds. When you think, only your imagination responds. One builds resilience, the other builds caution. Overthinking feels intelligent because it preserves your image. You avoid visible mistakes, you avoid looking naive, you avoid being publicly wrong. But wealth is rarely built by the person who avoids embarrassment perfectly. It is built by the person who tolerates small, manageable mistakes and keeps moving. The overthinking trap is subtle because it disguises itself as sophistication. But if you are honest, sometimes it is just fear wearing a well-tailored suit. And while you are carefully simulating outcomes, your not-so-smart friend is collecting data in real time. They are not smarter. They are simply willing to be imperfect sooner. There is a quiet myth intelligent people tend to believe. Once I feel confident enough, I will act. But confidence does not usually precede action. It follows it. This is where your not-so-smart friend has an unexpected advantage. They do not wait for certainty to feel brave. They move, feel uncomfortable, adjust, and then gain confidence through survival. Action changes the brain. When you take action, even imperfect action, you trigger feedback loops. You gather data. You experience small wins. You survive small failures. Each cycle slightly recalibrates your nervous system. You begin to realize something subtle but powerful. Most feared outcomes are survivable. That realization is not theoretical, it is embodied. Meanwhile, if you stay in analysis mode, your brain does something different. It simulates potential failure without ever testing its probability. The imagined risk grows in clarity and emotional intensity. You become cautious not because the world proved dangerous, but because your imagination proved creative. Your friend who started the lawn business did not wait to feel like a CEO. He knocked on doors. Some people said no. A few said yes. He underpriced. He overworked. He learned. Every interaction reduced uncertainty. Every mistake sharpened instinct. And over time, instinct replaced hesitation. That is the compound effect of action. In finance, this shows up clearly. The person who invests consistently through volatility builds something more important than returns. They build tolerance. Market drops become data points, not existential threats. Their nervous system adapts. The overthinker, however, waits for the perfect entry point. They tell themselves they are being disciplined, but what they are often protecting is not capital, it is ego. If you never enter the market, you can never be publicly wrong. If you never launch the project, you can never fail visibly. If you never negotiate, you can never be rejected. Safety feels intelligent, but safety does not compound. Action does. There is also a neurological component worth understanding. Dopamine is not just the chemical of pleasure, it is deeply tied to pursuit and progress. When you take steps toward a goal and see measurable movement, your brain reinforces that behavior. You become more proactive because action feels rewarding. Overanalysis, by contrast, produces diminishing returns. The first hour of research feels productive. The 10th hour feels necessary. The 100th hour feels justified. But none of it moves the external needle. Your not-so-smart friend does not have a superior cognitive engine. They simply step onto the field faster. And once you're on the field, learning accelerates. Confidence becomes a byproduct of exposure. Skill becomes a byproduct of repetition. Income becomes a byproduct of participation. The uncomfortable reality is this: you do not need more intelligence to build wealth. You need more exposure to imperfect action. Your friend is not ahead because they think less. They are ahead because they move before they feel ready. And readiness, in most cases, is a feeling that never fully arrives. Here is something that rarely gets emphasized in academic environments. Money moves through people, not formulas, not theories, not perfect logic, people. You can understand asset allocation at a sophisticated level. You can model risk. You can explain macroeconomic cycles clearly. But if you cannot build trust, influence decisions, or regulate your emotions under pressure, your technical knowledge has limited leverage. This is where many highly intelligent people quietly underperform, because school rewards individual cognition. Wealth often rewards social navigation. Promotions are not purely awarded to the most technically competent person. They are awarded to the person leadership trusts, the one who communicates clearly, the one who does not panic under stress, the one others want in the room when something goes wrong. Business is even more obvious. Clients buy from people they feel comfortable with. Investors back founders they believe in. Partners choose those who feel steady, not just brilliant. Emotional intelligence is not soft. It is practical. It is the ability to regulate your reaction when a deal falls apart. It is the ability to listen instead of dominate. It is the ability to sense hesitation in a conversation and adjust tone accordingly. Your not-so-smart friend may not have aced standardized tests, but they likely developed social fluency earlier. When academics were not their strongest asset, they leaned on connection. They learned how to read rooms, how to recover after saying something awkward, how to win people over without needing to sound impressive. Those skills compound aggressively. Think about negotiation. The intelligent overthinker often prepares perfect arguments, data-backed, structured, logically airtight. But negotiation is rarely won by airtight logic alone. It is won by emotional calibration, timing, tone, framing, knowing when to push and when to pause. The person who understands people has leverage. The person who understands spreadsheets alone does not. There is also something subtle happening internally. Emotionally intelligent individuals manage volatility better. When markets drop, they do not catastrophize. When business slows, they do not spiral. They regulate first, then decide. Emotional regulation preserves long-term strategy. Panic destroys it. And here is the irony. Highly intelligent people sometimes assume that presenting correct logic should be enough. If the math is clear, others should agree. If the argument is strong, others should comply. But humans rarely operate that way. We decide emotionally, we justify logically. If you cannot connect emotionally, your logic has nowhere to land. Your not-so-smart friend may not articulate financial theory elegantly, but they build relationships that open doors. They secure clients because they listen. They gain referrals because people enjoy working with them. They get opportunities because they are easy to trust. And trust converts into income far more consistently than IQ points do. This does not mean intelligence lacks value. It means intelligence without relational skill is underleveraged. And if you are honest, this might be the most uncomfortable part. Your friend is not just acting faster, they are connecting better. And in the long run, networks compound harder than knowledge alone ever will. There is a quiet addiction that intelligent people rarely admit to. Prestige, not in a loud, flashy way, in a subtle way. The kind that hides inside phrases like career trajectory and long-term positioning. When you were labeled smart, your identity became tied to upward mobility. You were expected to choose the impressive path, the respected field, the role that sounds good when someone asks what you do. So your financial decisions begin orbiting status. You pick the elite university over the affordable one. You accept the title with reputation instead of the role with equity. You upgrade your lifestyle as soon as your income rises because it feels like the natural progression of someone competent. It does not feel irresponsible. It feels aligned with who you are supposed to be. Meanwhile, your not-so-smart friend does not feel that same pressure. Take a simple example. While you pursued a prestigious consulting job in a major city, complete with high rent and polished office space, your friend started a small residential cleaning company. Not glamorous, not impressive at networking events, just consistent demand and recurring revenue. They began with 2 clients, then 5, then 15. They hired part-time help, then full-time. Over time, they built contracts with property managers. Their income became predictable. Their overhead stayed controlled. You, on the other hand, may have been earning more on paper, but you were also paying more in rent, commuting costs, social obligations, wardrobe expectations. The image required maintenance. Prestige has overhead. Cash flow has leverage. The intelligent path often optimizes for signaling competence. The average path often optimizes for profitability. And here's the part people do not like admitting. Prestige quietly encourages lifestyle inflation. If you work in a high-status environment, you are surrounded by spending that normalizes higher expenses. The car upgrades, the expensive vacations, the social pressure to keep up. Your friend with the cleaning business may drive something practical. They may live below their means not because they studied financial independence blogs, but because they simply do not care about signaling. That indifference compounds. Lower fixed expenses mean higher savings rates. Higher savings rates mean more investment capital. More capital means more optionality. Optionality is wealth, prestige is optics. One increases freedom, the other increases expectation, and expectation is financially heavy. Your friend may never have impressed a guidance counselor, but they may quietly own assets that generate income while you are still maintaining an image. The uncomfortable question is not whether prestige is bad. It is whether you optimized for admiration instead of accumulation. Because over 10 or 15 years, the person who chose cash flow over clout usually sleeps better and owns more. Now we get to the part that stings a little. Because this is not about markets. It is not about business models. It is not even about strategy. It is about who you believe you are. If you were praised for being smart growing up, that praise likely shaped you more than you realize. You were the capable one, the one who figured things out, the one teachers pointed to as an example. Over time, intelligence stopped being something you had. It became something you were. And when identity fuses with intelligence, risk becomes dangerous in a very specific way. Because failure is no longer just an outcome, it is exposure. If you launch something and it flops, it does not just hurt financially, it threatens your self-concept. If you invest and it drops, it does not just test your strategy, it tests your judgment. So you protect yourself, you delay, you refine, you wait for better conditions. Not because you lack knowledge, because you fear looking foolish. Your not-so-smart friend does not carry that same weight. They were not defined by intellectual superiority. They were defined by effort, personality, persistence, or sometimes nothing at all. So when they try something and it fails, it does not shake their identity. It is just data. They are used to learning publicly. They are used to not being the most polished person in the room. They are used to trial and error. That tolerance for imperfection is a massive financial advantage. Wealth creation requires repeated exposure to uncertainty, starting businesses that might not work, making investments that fluctuate, negotiating deals that could be rejected. If your identity demands that you always appear competent, you will subconsciously avoid these arenas. If your identity allows you to look inexperienced temporarily, you will enter them sooner. And time in the arena compounds. There is also a neurological layer here. The brain avoids threats to identity the same way it avoids physical threats. Social rejection, embarrassment, loss of status. These activate similar stress responses. So your hesitation may not feel like ego. It may feel like caution. But underneath, it is protection. Your friend who was never labeled gifted does not have as much identity to defend. So they experiment. They tolerate awkwardness, they make visible mistakes, and over time they desensitize themselves to the fear of looking wrong. You, on the other hand, may still be trying to maintain the image of being right, and that maintenance is expensive, because every month you delay action to preserve ego is a month someone else compounds experience. Your not-so-smart friend is not braver by nature. They are freer from needing to prove intelligence, freer from protecting a label, freer to move before certainty arrives. And that freedom, more than IQ, is what builds wealth over decades. This is the hidden variable. Not intelligence, identity. And once you see that, you begin to understand something uncomfortable but empowering. The ceiling was never your intellect, it was your attachment to it. Now you see it, or maybe you've been seeing pieces of it for years. Maybe you've felt that quiet frustration but couldn't articulate why it bothered you. Maybe you've watched someone less polished, less analytical, less academically impressive move ahead financially and thought something must be off. It's not off, it's behavioral. This is the moment that matters, because this conversation is not about lowering your standards. It is not about pretending intelligence does not matter. It is about recognizing that intelligence alone is incomplete. Wealth is not built by being the most informed person in the room. It is built by being the most consistently engaged, by acting before you feel perfectly ready, by choosing cash flow over clout, by tolerating short-term embarrassment for long-term leverage, by detaching your identity from always being right. And here is something important. None of this shifts overnight. It happens decision by decision, investment by investment, risk by risk, identity adjustment by identity adjustment. You do not wake up one morning suddenly financially confident. You build that confidence through exposure, through participation, through small actions that compound quietly. The real transformation is not in your income. It is in your posture. You move from hesitation to initiation, from over-optimization to execution, from protecting ego to building assets. And the person you become in that process is more valuable than any single financial milestone. So here's what I would genuinely like you to do. Be honest. Are you the overthinker right now? Are you sitting on capital, waiting for perfect timing? Are you protecting your reputation more than your upside? Or maybe you are the one who jumped early, made mistakes, and learned fast. Share it. Talk about where you are. Not to impress anyone, not to perform, but to reflect. Someone reading your comment may recognize themselves in your pattern. Someone slightly ahead may offer a perspective you have not considered. Someone behind you may need proof that imperfect action is survivable. Financial growth does not have to be isolating. It can be collaborative. And if this video shifted something for you, even slightly, subscribe and stay. We are not building hype here. We are building clarity. We are building behavior. We are building long-term wealth through long-term identity shifts. Remember this. Your not-so-smart friend is not ahead because they think less. They are ahead because they move faster. And the moment you stop trying to protect the label of smart and start protecting your future self instead, that is when everything changes. I'll see you in the next one.